Morning, folks, and welcome to our workshop for advanced price action technical analysis, specifically getting to the point where you'll be able to use these wave patterns, WM heuristic patterns, as I like to call them, and add that as another significant few strings to your bow in your trading arsenal. So let's hope that today's going to give you some real aha moments and give you some sort of additional advantage. I know a lot of you are also doing, many of you are doing pretty well as it is. Certainly when market conditions are favorable. I don't think anybody's doing very much at the moment. But we hopefully, maybe even from today, we'll start seeing some movement again in the markets. I think the market's pretty much waiting for this major news coming out of the States. The Biden administration is trying to play down the fact that it looks like they're into a recession, and the data coming out this week, and specifically today. In fact, I think GDP tomorrow, maybe. Let's have a quick look. I've got it up here. Yeah, tomorrow, advanced GDP quarter on quarter. That's also a big number showing, well, let's see if that actually does show another constriction. The forecast is not for a constriction, but if that comes out as a minus number, then it is technically a recession with two minus quarters in a row. So that's going to be interesting to follow. So I think a lot of I mentioned the fact that we've got the Northern Hemisphere holiday season starting now, but also I do think that this big news in the States is something that people are waiting on before we see any further movement. All right, so in any case, just a quick rundown for today. Let me go back to where I was, and there's that sticky. There we go. I think you all got the breakdown for what we're going to be covering today. So starting off now just with a bit of an introduction, and just want to make sure that we're all on the same page. And it really is just about talking about the concepts again. So concept number one, first of all, is that, well, just to understand what price action is actually all about. So price action is so valuable. I believe it's so valuable because it represents the collective mindset of the market. Now, when I say that, what we're recognizing is the fact that human beings have these things that we call cognitive biases. And we actually operate according to these cognitive biases much more often than what we think. In fact, the majority of the time, we have managed to convince ourselves that we are a very rational species, and each of us is convinced that we only make rational decisions. But the more you learn about the human brain, the more you start questioning whether that is in fact true or not. So when it comes to trading, of course, these cognitive biases are very powerful. We've all heard about how important it is to have a trader's psychology, a good trader's mindset, how important it is to overcome emotions. There's lots of discussion around that, as we know, and we go into that in quite a lot of detail, of course, in the academy. We spend a lot of time and effort on the practical elements of applying yourself to developing your trading mindset, which means controlling your expectations and through that your emotions. So I'll come back to that again in a bit. But the main thing for us to realize is that a lot of the market movement, if not most of it, if not all of it, is a result of these collective cognitive biases playing themselves out. Now, what do I mean by that? Well, let's look at just a couple of them briefly. We don't want to spend a lot of time on this. There's a lot to cover today, but it's important that you understand that, for instance, support and resistance, which is one of the two key elements of price action, is based on this cognitive bias called anchoring. And anchoring really simply is when folks, when the market, I should say, or even an individual has anchored their perception of value at a certain level. So I often use the example of buying a house. Now, we've got folks here from different parts of the world. Currently, I'm based here in my home country of South Africa, as you know. So in the area that we live in, there's some very, very nice suburbs, and nice houses, and so on. So if I said to you, in a really, it's a nice area, and South Africans will really identify with this. The house in this really, really nice upmarket area costs 200,000 South African rand. And for you guys today who are South Africans would say, well, that sounds incredibly cheap for an upmarket house in an upmarket suburb. Let's say it's a 4-bedroom house, swimming pool, you name it. Half a hectare property. You say that's incredibly cheap. Well, the only reason you are able to say that is because you have anchored your perception of value to a certain number. If I'd said 5 million, you would have said, okay, that sounds maybe more reasonable. You wouldn't have argued with that. If I'd said 100 million, again, you would have said, no, that sounds ridiculous. What are we talking about? A castle? We're talking about, 1,000 hectares of property. It wouldn't make sense to you either. So your perception of value is anchored for a nice house in an upmarket area in a South African suburb to, around the, let's say 3 to 5 million level. And you wouldn't be surprised at that. So that's what anchoring is all about. And of course, that happens in the charts as well. So when you look at a chart and you see that price has been hovering around the same level for a while, your perception of the exchange rate would be anchored at that level. And if the market moved significantly away from that, you would have this instinctive feeling that it needs to come back to it. It needs to come back to that level, and it very often does. And of course, that's called the reversion to the mean. Now, the reversion to the mean is you get strategies that are called reversion to the mean strategies, and the observation of the fact that the market very often does revert to the mean is a result of the cognitive bias of anchoring. That's what it comes from. And support and resistance likewise. If we've seen the market in a range and it's bouncing off a resistance level at the top and a support level at the bottom, is because the market as a whole is pretty much in agreement. There's consensus that that is the appropriate exchange rate for that currency pair, or if it's a price of gold or an indices or whatever, index or whatever. So that's really what it is. Now, if we have a breakout from a range, it typically means that that consensus has been broken. So if the market breaks out of and we'll look at this later on, in a bearish direction out of a range, that means that the consensus of what a fair value is has changed, and that it's actually lower than what it was. Then you'll often see a retracement back to the level that was broken. And again, that's a form of reversion to the mean. And it is also a result of anchoring. So that's really just a very quick a look at what a cognitive bias can be. There are others. The disposition effect is another one, which is the tendency of people to throw good money after bad, or to treat money that you have not yet lost as more valuable than money that you've already lost, in an effort to try and recover the money that you have lost. So these are all typical of cognitive bias. Now, we don't have to go into what these are. That's not my intention at all. But it's important to recognize that price action comes about as a result of these cognitive biases. Okay, so I'm not going to spend too much time writing and typing. All right, so that's the first thing. The second thing that you can see now as well is that this is tied completely to trading psychology. Oops. So why would that be the case? Let's just expand this a bit. I'm sure we can make it bigger somehow. Trading psychology. Now, you guys might have noticed that in one of the ads that we put out for this workshop, it talks about being able to predict the market. Now, I won't tell you who wrote that ad. I'll just say that it wasn't me, because anybody who spent any amount of time with me in trading as a trader will know what my feeling about market prediction is, and that is that it is completely impossible. we are just as likely to be able to consistently, reliably predict the market as we are to be able to tell the future about anything. And of course, we know that we can't do that. That's why people spend a lot of money going to tarot card readers and maybe a gypsy who's got a crystal ball. And we call that the crystal ball syndrome, as you know very well, for those of you who have spent time in my training. And I think just about everybody here has. So it's important to see, obviously, and I'm sure you can see now, that cognitive biases are a psychological phenomenon. But trading success comes from the fact that we are able to use the cognitive biases, these psychological phenomena of market participants against them. Our strategies and the way of course, reading a chart, which is what today is all about, is completely based on the fact that price moves in accordance with these cognitive biases. So a phase one wave, talking about cyclicity, which is the other element, as I'll talk about in a minute again, of price action, is typically a result of the disposition effect. And then, of course, support and resistance is typically a result of anchoring. Those are the two most important. There are a couple of others as well. But again, we're not really too fussed about those. It's just important to understand that that is where our analysis, or what our analysis methodology is rooted in. It's not just some pie in the sky, unproven theory. It goes straight into the observable psychological dynamics of the market participants. And we look to understand that and build trading and a trading approach around that approach generally. And of course, at a technical level, that's made up of two things. The first is technical analysis, and the second then is strategy. It's also worth pointing out, though, our strategies are built on what we observe in our technical analysis as well. We just systematize things, and we'll talk about that obviously quite a bit later. All right, so I just wanted to introduce you with that. The other thing I just wanted to mention as part of this introduction, folks, is you may have seen already that we would like you to please ask your questions in the Expert Tips and Winning Strategies Facebook group. You should all be a member of that. It is a private group, so if you are not already a member, you can search it out and request to join. Corinne is here with us today. She's my co-host, and she'll be keeping an eye out for requests to join if you're not already a member. But the point being, I have, as you will see here, put in a post where you can simply pop your question into the comments. Now, I'll be answering some of those today. The rest will be done in the VIP session as promised. I think I assume that everybody here, actually, I know that just about everybody has signed up for the VIP session. It's really worth doing it, folks, because especially if you are not a member as well, those who are not members and who are part of the VIP session are going to get an additional amazing option to spend some time with us in the academy, just to try it out and see what we're doing there. It's really important to be able to do that. All right, so questions, please post them in the comments section of this post in the Expert Tips and Winning Strategies group. Right, so obviously we do have the chat box as well in Zoom, but I'd appreciate it if you don't use that, rather use something that we can all see in the group. Obviously, also when we finish the Zoom session, the chat gets lost, so I'm not going to be keeping that. All right, let's thank you, Corinne. She's posted in the chat box where you can actually click to join that group. So as we go through this, any questions come up, just put them in and we will be sorting through those and addressing them a bit later on. Also, just note, I don't know how long today is going to take. I haven't actually done a workshop like this before. We do need to do some revision of basic concepts. I noticed that many of you who've been around for a while haven't actually haven't revised the basic concepts for a while, and there are also some of you here who don't know much about that at all, which again is why we're going to be making the Academy training material available to you for a couple of weeks so that you can learn all of that. All right, so within our the Trader Development Center, we have got obviously the technical analysis section, the discussion around the more advanced stuff when it comes to WM patterns, which we're going to get to later on today, is in the advanced trading. But I'm actually going to go back to, well, I'm going to go to module 3, jump straight into module 3 with our price action methodology, and just talk quickly about a few things that are important. I also have had this discussion with several people who've been in the academy for a while, again recently, and there's been some misunderstanding. We've also got a few new folks as well who are very welcome and have been asking me a lot of questions, which are also very welcome. Roy, you in particular, thank you for that. Glad to see that you are here today. So I'm going to just run through some of that stuff quickly as well, and make sure that we're all on the same page, because if we're not, then everything else that I talk about later on is going to become increasingly confusing. So, right, let's just have a look quickly. Who else is here? Okay, welcome, Gary. Long time. Okay, awesome. So I think that covers the introductory points that I wanted to make. Let's move on to the second point of today, which is this brief revision. First of all, as you know, with price action, we have got these two key elements that really are the building blocks of everything else. And those are support and resistance and cyclicity. Now, you might ask me which of those is more important. I would generally actually favor support and resistance, because cyclicity forms as a consequence of price interacting as a result of all of those cognitive biases of market participants, of price interacting with levels of support and resistance. Now, obviously, it is observably true that we don't know where those levels of support and resistance are, particularly in the Forex market, and particularly in a spot-based market like we trade in. If we were to get into trading centralized exchanges, so if we could trade on a futures exchange and where the market is centralized, and of course the Forex market is not centralized, then it may be possible to look at things like volume and also depth of market. Now, all the depth of market really is saying, where do we have deep levels of liquidity, which are formed by limit orders. Now, I don't want to go into all the detail around this. Again, this is in the training, and we've even got YouTube videos on this. But by now, you should be very familiar with the fact that you have 3 types of ways of either entering or exiting the market. And those order types are at market, which is where you click buy or sell or exit, and it happens immediately or close to immediately. That's an at market order. Or you can have a pending order, and those are the other 2. And the one is a stop order, and the other is a limit order. So the stop and limit orders are our pending orders. Now, I very often ask people, right, of those 3, which are the most similar? Which have the greatest similarity in terms of characteristics? And most people will say, well, clearly it must be the stop order and the limit order, because they're both pending orders. Now, that's actually incorrect. The 2 types of order that are most similar are at market orders and stop orders. And the reason for that is because when price gets to your stop order, be it an actual stop loss or an entry stop, that order converts to an at market order. That's what happens. Whereas a limit order is actually quite different. Now, how are these different? And what does that actually mean for us? Well, first of all, when you execute at market, what you're doing is you're saying to your broker, get me in or out of the market at the best price you can as soon as possible. That is basically what that order means. That's what you're telling the broker. Get me either in or out. Doesn't matter if it's an entry or an exit, at the best price you can as soon as possible, which basically means at the price I'm looking at right now. Now, they can't necessarily do that. And the reason they might not be able to is because in order to settle your order, it needs to be settled against an order from somebody else. There needs to be a counterparty to your order. So if you want to buy something, there needs to be a willing seller. I mean, you know that already. And it's the same in the market as it is anywhere else. Now, people tend to forget this because in these very highly liquid markets, when you click that button, it's like instantaneous. And it doesn't look like there's any need for a counterparty, but there actually is. Even if it's a market maker, even if it's a liquidity provider, whatever, there is still a counterparty to your order. And your broker's job is to find that counterparty and settle your order against that counterparty's order. Now, those orders, if you are executing an at-market order, that order will be settled against a limit order. And if your order is a stop order, buy stop, sell stop, stop loss, whatever, it will also be settled against somebody else's limit order. Now, a limit order is different from those for that reason, because when you place a limit order, what you are saying to your broker is, I want you to get me in, be it a buy or a sell or even an exit, because your take profits, by the way, are limit orders. I want you to get me into the market or out of the market at this price or better, but not worse, as long as it takes to get me that, which is almost the opposite of a stop or an at-market order, which again is get me in or out of the market as quickly as possible at the best prices that you can. A limit order is the opposite of that, is get me in or out of the market at such and such a price or better, and you can take as long as you like to get it, but I don't want a worse price. So very, very different. Now, why is this important? Because liquidity, folks, comes from limit orders. And when you have deep bands of liquidity, you have strong levels of support and resistance. That's the key. Support and resistance comes from deep bands of liquidity and a price level where there's lots of liquidity. What does it mean when there's lots of liquidity? It means where there's lots of limit orders. Now, obviously, if it's a support level, it means there are buy limit orders. And if it is a resistance level, it means those are sell limit orders. So think about this. We'll look at it on a chart again a bit later, but it's really important that you understand, this stuff actually comes from somewhere. This is not, it's not like a computer game. You're not playing, I don't know what these computer games are called, where you're running around in some fantasy world shooting at people and they're shooting at you. And if you get killed, you can just pop back to life again. This is real. Okay, there's real people on the other side of your trades, and what is actually happening in the market is real. So it's often easy to lose track of that when you're staring at a screen for days on end, watching the prices go up and down and trying to figure out what's going to happen next. We tend to forget that these are the consequences of decisions of real people, what real people are making from all walks of life. Some of them are at a corporate level, some of them banking, some of them are speculators, some of them really are just trying to mitigate their risk. Big companies moving money internationally. There's a zillion different reasons for transactions taking place in the markets, especially the currency markets. Obviously, if you're talking about indices and so on, not so much. That's where that's much more speculative. But it's all, at the end of the day, it's as long as the markets are volatile and liquid, it all comes down to the same thing. All right, so there's quite a bit there. I think that some of you might have questions about that. If you want me to elaborate on that, then again, that's an area where you might want to have some specific questions for me. Just pop that into a comment in the Facebook group. All right, so having said all that, then we talk about price action then being these two things, support and resistance, which I've now elaborated on where that comes from, as well as cyclicity. Now, cyclicity obviously is just how price is interacting with those levels. That's how it forms. And when a wave comes to an end, and of course, now we're talking about cyclicity, well, it means if it's a bullish wave, it means it must have met with a resistance level. Because if it hadn't met with a resistance level, which would be a deep band of sell orders, then the price would have carried on going. And vice versa. If you've got a bearish wave and that bearish wave comes to an end, it means that there's excess buy limit liquidity compared to how much is required by the market at that point in time. Now, that's telling us nothing about the total volume. That can happen at either very low volumes, it can happen at really high volumes. The battle between those folks who are looking for liquidity and those folks who are providing liquidity, that can happen at any kind of level of volume. Of course, if volume on one side picks up dramatically for any reason, let's say there's a news announcement and everybody wants to sell, then that means that the demand for the market's demand for buy limit orders will increase dramatically because people are executing sells at market. They're selling at market, and if you try to sell at market, it needs to be settled against a buy limit order. So the demand for buy limit orders or liquidity increases dramatically. And of course, if the supply of that liquidity doesn't increase, it will tend to mean that you have a bearish breakout. Okay, so I hope that all makes sense. As I say, we can look at that with a bit of a practical sort of on the chart example, rather than just talking about it. Okay, so that leaves us then with these two building blocks of price action. And I want to move on now from that, because what we do is we put those together in everything that we do with our technical analysis. So be it identifying channels, the LPO method or the HDC method, identifying those support and resistance levels, or the WM patterns, we are looking at either support and resistance, or we're looking at cyclicity, or both, of course, because cyclicity really is just the other side of the coin from support and resistance, and you can't have the one without the other. So if we're looking at a W or an M pattern, you can say to me, well, that represents cyclicity. Well, actually, no, it represents both, because you've got 4 waves there, and those 4 waves, apart from the last one, which is incomplete, all came to an end. And they came to an end where? Well, if they're bullish at a resistance level, if they're bearish at a support level. Okay. And then classifying those waves obviously tells us about how the market is interacting with those support and resistance levels. And we'll come back to that a bit later. But in order to be able to do all of this, you need to be able to now use this methodology called the 3 steps to heaven. And I don't want to spend a huge amount of time on it, but getting to heaven in this methodology, as you guys, most of you should know and remember and love, is all about being able to identify whether probabilistically you're in a trend or a range. Now, I say that word probabilistically again because I want to keep tying this back to the fact that trading is a probabilistic enterprise. You are never able to know for sure what's going to happen next in the market. It's all about taking a probabilistic approach and maximizing our expectancy using the 3 pillars, as you know very well. I'm not going to go into all of that again, but those pillars being, of course, first of all, having an edge. That edge should be a convex edge, and we apply that convex edge using the law of large numbers. That's how we dominate over the uncertainty in the market. So you know all of that already. And folks, for those of you who are new to this, if this is something that is baffling to you, it's because you haven't yet done the basic training in our course, and that's why you really need to make sure that you take me up on basically a free offer to get access to all of this training over the next month or so. All right, so let's jump into how we get to the point or get to heaven, which is being able to answer the question, do we have a trend or do we not have a trend? And of course, if we don't have a trend, we assume that we've got a range. Those are the 2 basic types of market condition. And all technical analysis is about being able to answer that question. That's what it comes down to. The most important question in technical analysis is probabilistically, do we have a trend or do we have a range? That's it. From there, you can start doing other stuff. But if you can't answer that question, you've got nothing, absolutely nothing. And that's what the 3 steps to heaven methodology is designed to help you to do. So again, I'm not going to go through that, you can watch the videos again. For those of you who need to summarize your your understanding of this, you can do that. What I'm going to rather do is have a look at a practical example of this. Just to use that. Actually, I want to go back to that a little bit later. All right, so let's just have a look at any chart. I'm just taking the Euro USD and I'm looking at the 4-hour time frame because it's been reasonably interesting over the last while, where we've had the end of a higher time frame bearish trend. But anyway, we'll look at that in more detail a bit later. So in order to be able to determine whether we have a range or a trend, the first thing we need to be able to do is identify our waves. If you cannot identify the beginning and the ending of a wave, you're screwed. There's nothing else that you can do. You cannot answer any of the other questions. You can't move forward. You don't proceed beyond go. So how do we define the beginning and the ending of waves? Well, we use something called fractals, otherwise known as isolated highs or isolated lows. And all we do is, you can start from the left and move forward, or you can start at the end and move backwards. I'm just going to pick a starting point on the left being the lowest low over the last week or so on this chart, and say, right, well, that is a fractal. Why is it a fractal? Well, because it is surrounded by a higher low on either side. So it is a low fractal, otherwise known as a, believe it or not, a cell fractal. If it was me choosing the names, I would have called it a bifractal, but maybe I'm wrong about that, because at the end of the day, what it also means is that if you're in a bearish trend, well, if you're in a phase 2 and you've got a bifractal, it means that the market's probably going to continue going up. So in any case, don't allow yourself to be confused. I prefer to just to call it a low fractal or a high fractal. Here's a high fractal. Why? Because it's surrounded on either side by a lower high. That's that. And what we do with defining the beginning and the end of each wave is we understand that the end of each wave is also the beginning of another wave. So if that's the end of a bullish wave, it must be the beginning of a bearish wave, which is there. Now that bearish wave has to come to an end at another fractal, which lo and behold is the very next candle, which has got a higher low on either side. So for those folks who are really familiar with this, I apologize, but we do need to just make sure that everyone's on the same page. All right, so that's the end of a bearish wave, the start of a bullish wave. Well, there's a high fractal. It's got a lower high on either side. But guess what? If we were to try and find the end of a bearish wave here, we'd be stuck because, well, the market keeps going up before we actually get the next low fractal. Now, to be honest with you, it doesn't really matter what you do at this stage. However, what I prefer to do is just to make sure that the market doesn't make a higher high above that high before we get that fractal. In this case, it did. Clearly, you can see the market went higher before we got a low fractal. So we need to actually treat this as a continuation. And therefore, that's actually what it looks like. And that there is another high fractal, but in this case, it was followed by a low fractal first before the market went higher. Okay, so another way of looking at this is if that isolated high or low is isolated by the third candle being an inside candle or inside bar, which you can see this one is, then you are in danger of that being a non-relevant, as we call it, isolated high. If, however, this is not an inside bar, it would either mean that it was higher, in which case it's not a fractal at all, or it would mean that that low was lower than that low, in which case it's what we call a ringed high, just like, I beg your pardon, like that one, that's a ringed high. Now here we had another third candle being the inside bar. That third candle therefore meant that that was potentially a non-relevant isolated high. But as soon as the market made a lower candle low, which it did immediately with this candle, it meant that that high was therefore ringed. Okay, so this is where a lot of people get stuck, and it's step one of the 3 steps to heaven. Now, also bear in mind that this is a methodology. It's important to get it consistent. Consistency is the key to everything in trading. So if you have another methodology that works, then it's fine, but make sure you use it consistently. Isolated high to isolated low to isolated high, and so on. So here you can see that's a potentially non-relevant isolated low inside bar, and in fact the market went lower before we got an isolated high, so it's another continuation of that wave. And there we go. When the market starts getting really messy, like it did over here, chopping around, then you're probably not going to, you're definitely not going to be trading that anyway. So if you don't get that 100% right, it's not the end of the world, because you should recognize that you want to stay far away from trading it. All right, so there we go. Isolated high to isolated low. You can see it got really choppy around here. Here's another one. This is an interesting one, actually, because here we have an inside bar. This bar is in fact still inside both that one and that one. The point being is, where is my wave high? Well, you can say, well, there it is. This is tricky because the market actually went higher than that at that point in time. Now, what do you do here? Well, you could either say, well, I'm just going to do that. And that, technically I wouldn't say necessarily is wrong, but what I would do here, and I've written my software to recognize it like this, is say, well, this is a bearish candle, which means that low came after that high. That high has been isolated by these candles over here. So that came first. Therefore, I can say from there, we can go to there. You might want to ignore it because it actually went higher in between. That's something you could do, would be fine as long as you do it consistently. And now we have a single candle wave because it went from isolated high to isolated low. If this was a bullish candle, we would treat that as a non-relevant high anyway. All right, so again, now it gets easy. Low to high, high to low. The other thing to just for me to reiterate is if some of this seems like it's really confusing and you're not getting it 100% right, it usually doesn't matter, again, because you wouldn't be trading this market. When the market starts trending like this, it's really easy. And those are the ones we're most interested in anyway. All right, so I'm pretty much up to date here. This candle is not yet over. We've still got about, 22 minutes left. I'm going to assume it closes like that. It's an bearish engulfing candle. I normally assume that it's going to give us an isolated high, because even if the market went higher after this, then okay, if the market turns around and immediately goes higher, I'd have to ignore that and say that I was wrong about it, and that's fine. We're not in the game of prediction over here. We need to go with what is most likely at any point in time, and there are times where we revise that estimate based on the fact that we don't know what that next candle is going to look like at all, which will be closing in 4 hours and 22 minutes time. All right, so that is step one of the 3 steps to heaven. It is about being able to identify the start and the end of our waves, and if you can't do that, you're screwed. Right, so the second of the 3 steps to heaven now, having done that and done it correctly, is being able to identify which type of wave we have. Now, obviously, we can classify waves as bullish or bearish, up or down, and that's pretty easy. But there's a much more important classification, as you all know, and that is a wave an impulse wave or corrective wave? An impulse wave is also known as a phase 1 wave, and a corrective wave is also known as a phase 2 wave or a retracement wave. Okay, so let's just stick to, I'm going to try and stick to phase 1, phase 2. Many of you were taught that from the beginning as well in your previous trading. But if I say impulse wave, you know that I mean phase 1. And if I say corrective or retracement wave, I mean phase 2. All right, so what is a phase 1 wave? And this is another thing that people like to get wrong. And the answer to it is often given as a phase 1 wave is longer than the previous wave. Well, it is true that all phase 1 waves are longer than the previous wave, But unfortunately, it is not always true that a wave that is longer than the previous wave is a phase one wave. So a lot of people don't get that right. I think most people here understand it clearly, but let me reiterate this again because it's such an important point. When it comes to trading, and especially if you're new to trading, you're dealing with concepts that are new to you. So looking at a chart and everything that we're checking out here on the screen is brand new. It's not something you're taught in school. It is very unfamiliar. And all of these concepts, it takes time to absorb them and understand what they are. So it's very easy for someone who's trying to teach you how to trade to be able to simply say, look, a phase one wave is a wave that's longer than the previous wave. That's easy, but it's a cop-out. It also ignores the fact, it ignores some very, very important information that the market is giving us. And in order to be successful as a trader, of course, you want to use all of the valuable information and ignore the noise. You want to actually strip out the noise, and what you're left with is information that helps you to make decisions or to apply a strategy. All right, so what is the difference then if a phase one wave is not necessarily longer? So the best way that I like to illustrate this, as many of you know, is the logical mistake that you're making when you assume that a phase one wave is a wave that's longer than the previous wave. The logical mistake you are making is as follows. When it comes to pets, most people have got cats or dogs. So let's look at dogs. Would you agree with me that all dogs are animals? I'm sure the answer is yes. Okay. Therefore, it is true that all animals are dogs, which is clearly nonsense. And that is what you're saying when you say that all waves that are longer than the previous wave are phase one waves. It's not true because you're effectively saying that all animals are dogs. Right. So what do I mean by that? Well, here is a wave right at the top. That's an important one because it's the end of this trend, as we will see in a minute. Here is a wave that is in fact longer than the previous wave. Okay, so we have a bearish wave and here we have a bullish wave. It's not much longer, but I'm sure you can see that it is longer. So if I put in a horizontal line here, there you can see it pop just above it. So this wave is longer than that wave. Likewise, in fact, this wave is longer than that wave. Does that make these waves phase one waves? And the answer is no, actually, it doesn't. In order to be a phase one wave, it must not only be longer, it must also be stronger. And what does that mean? How do we know if a wave is stronger? Well, we've got one thing, there's a few things we can go by, but one thing that is really simple and is the best way of making a determination about this and achieving our objective, which is to strip out the noise and be left with useful information, is to not just look at how far it went, but also did we get a close? Did any of the candles in that wave close above the high of the previous wave if it's bullish, or below the low of the previous wave if it's bearish? If we did get a higher high, higher close, then the answer is yes, it is a phase one wave. However, if it failed to do that, then the answer is no, it is not a phase one wave. And if it's not a phase one wave, it means it's a phase two wave. Right, so let's just look through all of these waves and classify them. Starting from the left, did this wave give us not only a higher high, but a higher close? Now, we don't have that wave in place, but it actually, the previous wave would have started there. Did it give us a higher high, higher close? No, it didn't even give us a higher high. So it's a phase two. There's a bearish wave. Did this bearish wave give us a lower low, lower close? Clearly not. Therefore, it is also a phase two. In this bullish wave, did it give us a higher high and a higher close? Well, absolutely yes. It did it immediately. Therefore, it's a phase one wave. This bearish wave, did it give us a lower low, lower close compared to the previous wave low? No, it didn't. Therefore, it's a phase two. There's a bullish wave. Did it higher high, higher close? Yes. Phase one. Bearish wave? No. Phase two. Bullish wave? Higher high? Yes. But did we get a higher close? No. So it is also phase two. Bearish wave? Lower low, lower close? Yes. Phase one. Bullish wave? Higher high, higher close? No. Phase two. phase two, phase two. Yeah, I think that's also phase two. Let's just double check. You can always check the numbers exactly. Can't say. So the low on this candle is 1530. The close on this candle is 1531. So this close is 0.1 pips above that low, which means it's not a lower close, which means it's a phase two. So you can see this is longer. It's definitely longer than that previous wave, but we didn't get a lower close. So it's phase two, phase two. What about this one? Higher, higher, higher close. Yes, phase one, phase two, phase two, phase two, phase two, phase one, because we did get a lower, lower, lower close. Excuse me. And well, assuming that this wave is over, definitely phase two, unless it shoots all the way up and closes above that high. Right. So that's how we answer that question. What type of wave is it? Not just is it bullish or bearish, but is it a phase one or phase two wave? Now, why is that important? Well, for a few reasons. First of all, as price action traders, remember the question. The question is, do we have a trend? Yes or no? That's getting to heaven. Well, that's step two of the three steps in getting to heaven, which is being able to answer the question probabilistically, do we have a trend? Yes or no? Now, in order to be able to answer that question, we need to know what a trend is or how to define a trend in these terms. Now, remember the two elements of price action are support and resistance and cyclicity. Those are the two building blocks. And you need to be able to define a trend in terms of those two things. And it's really simple. And again, it's there in all of your training material. So those of you who need to revise this, I'm not going to belabor the point any further. In terms of cyclicity, it's an intact sequence of phase one and phase two waves. As my music teacher as a child used to tell me, 1, 2, 1, 2, 1, 2. When you've got that, you've got a trend. Okay. The other really important thing about a trend, though, is it needs to be outside of the range. So even if you've got 1, 2, 1, 2, but it's inside your defined range area, then it's not actually a trend either. Okay, we might see some examples of that, but usually it's not such a big deal. But if you need to be able to make a call on that, it's really important to note that just having 1, 2, 1, 2 is not necessarily a trend. We do, when we look at wave patterns as well, and we look at class 1 patterns and class 4 patterns, we want to just trade those, and we're not channel traders. We might just treat those as trends, and we'll look at that a little bit later. But for the purposes of formal definition of a trend, it needs to be, first of all, outside of the range, and secondly, it needs to be showing us that intact sequence of phase one and phase two waves. So that's in terms of cyclicity. The definition in terms of support and resistance would be a consistent breaking of, let's take a bullish trend like we have here, a consistent breaking of resistance and respecting of support. Okay, so if we look at this price movement here, where I started on the left, you can see that the market consistently made higher highs and higher lows. And by the way, that's another way that people very often would define a trend. That's not complete. It's another dogs and animals problem. Okay, all trends, all valid trends do give us higher highs and usually higher lows if they're bullish, and lower highs and lower lows if they're bearish. But that doesn't mean that all higher highs and higher lows in sequence are going to give you a bullish trend, for the same reason as we discussed with phase one waves just now. All right, so yeah, this is actually a phase two wave, phase two, but then we've got phase one, phase two, phase one. And that is actually enough, as Roy pointed out to me the other day in a question, is if you've got phase one, phase two, phase one, that second phase one actually gives us a second phase one outside of the range, by the way, gives us an established trend. Okay, that's when we can say that we have an established trend, is when we have that second phase one outside of it. Now, in this particular case, what happened after that is that we had a phase two, which means that that sequence was no longer intact. Phase 1, 2, 1, 2. Well, we had 1, 2, 1, 2, 2. We no longer had an intact sequence of phase one and phase two waves, which means that our trend was dead. The definition of the trend is no longer met, therefore it's done. Okay, that means that if the market is no longer trending, we can then assume initially that we're in a range. And you'll remember that when a trend comes to an end, we actually have the 3 R's, the first of which we assume, which is range, but there are 2 other possibilities. The one is resumption, and the other would be a reversal. Okay, so we'll look at some of those later on, but that's not really what we want to spend time on today. Again, if you need to revise this stuff, please make sure that you go through all of those sections in the technical analysis training part of the or course in the academy. All right. So what next? Well, let's have a look what came next over here. When our trend came to an end, we started having a bit of a hodgepodge, didn't we? So phase 2, phase 2, phase 1, phase 2, phase 2, phase 2, phase 2, phase 1, phase 2, phase 2, phase 2, phase 2, phase 1, phase 2. So it's pretty much all over the place. So can we, at what point can we now say, hey, do we have a trend again? Well, apart from the fact that we're looking for an intact sequence of phase 1 and phase 2 waves, as I mentioned just now, what we're also looking for is a breakout of the range. You can't say that you've got a trend until the market has broken outside of the range area or consolidation area. Now, remember what I mentioned earlier is when there's consensus amongst market participants that the price of an instrument is reasonable, it's going to consolidate in a range area. And we can clearly see that the market did that here, okay, and has done that for quite some time. There's a possibility we might see a breakout through the course of today in a bearish direction. Possibility, no guarantee, we'll see. And for the moment, it hasn't happened. But can we say that we're in a range? The answer is clearly yes, but where is the range? How do we define the range dimensions? And how do we do that as quickly as possible after a trend comes to an end? And of course, that's what our channel methodologies are all about. So our trend comes to an end. By the way, we're obviously now on step 3 of the 3 steps to heaven, because we're answering these questions. Do we have a trend, yes or no? Well, our trend came to an end when we had a breakdown in that cyclicity. If we're using the LPO method, well, LPO stands for last phase 1. And it means it's the last phase 1 that you can see at the moment in time that you have identified the trend has come to an end. Now, when did that happen for us? Well, it happened for us when this bullish wave here failed to give us a higher high, higher close. And that happened when that high was ringed. And that high was ringed at the close of this candle, which is there. That's when it gave us a lower high when this candle is finished, because once this candle is closed, it's set in stone for all time. That ringed that high, which means that that bullish wave was over and it failed to make it as a phase 1 wave, which means it's a phase 2 wave, which meant that our sequentiality of cyclicity had broken down, which means we no longer had an intact sequence of phase 1 and phase 2 waves, which means we no longer had a trend. That at that moment in time, literally the opening of this candle here. Now, at that point in time, where is the last phase 1? Well, it's here, isn't it? That is the last phase 1 wave. And that, folks, is the initial dimension using the LPO method of our range. Now, that range will only be binned and left behind in history forever when we have a valid breakout. Okay, now you can have 2 types of breakouts. You get false breakouts and you get valid breakouts. Now remember, valid breakout is when we have a new trend. And you know what that is. It's when we have an intact sequence of phase 1 and phase 2 waves with the second, at least 2 phase 1 waves outside of that, closing outside of that range. All right, so that's it. Simple. Now here we have a bit of a test, which means we can adjust our dimensions. Some people, will only expand it if there's a false breakout with a close outside, but the fact of the matter is the market did test that level. So that's what we had up until now, in terms of the resistance level. Tested that level, but it's failed to get above that. And a support level, it respected this support level all the way through, right up until, what time was that? Yesterday afternoon, where you can see it tested it. We got a slight close outside over there. So technically that's a breakout. But in order for us to have a valid breakout, we need to have a second phase 1 closing outside. So we've got 1 close at the moment. But in order for this to be a valid breakout, we need to have a second phase one wave closing outside of that range, which we don't have yet. But we don't have a false breakout yet either, because that might happen. But if it doesn't, if we fail to get a bearish phase one wave here, and we have, I'm just going to use this as an example. Oops. If that were to happen, then it would be a false breakout because we don't get a second phase one, in which case I would then expand the dimensions of my LPO range to take that into account. Right, so that's the LPO range. Just a quick gallop through that. Let me just and by the way, here we're talking obviously about how we're defining these channels. How do we actually do that? And that's how we would do an LPO channel. All right, so folks, let me just go and double check. See if you've got any questions for me. If you want me to just go over any of these elements again, then I'm happy to do that. There you can see predict the markets. No, we don't predict the markets. Okay. Precious. Let's say. Barbara's asking about how you book for tomorrow. Barbara, so tomorrow is the VIP session. If you haven't yet booked for VIP, then just please send you should have received an email about that already. You just need to do that. I see that Kareen's probably, oh, okay. So Kareen's speaking to you about that already. Thank you, Kareen. All right, so no other questions so far. That's great. All right, so let's take a quick 2-minute comfort break. I just want to get something for my throat. What happens when I start talking a lot after days of not talking. My beloved is actually away at the moment with family, about to see my daughter off to Thailand. So I haven't really been speaking much for the last few days. Not used to it. Okay, so let's just go back to this and pause the recording.